John Cassidy, How Markets Fail, The Logic of Economic Calamities. In How Markets Fail, The Logic of Economic Calamities, John Cassidy explores the 2008 financial crisis and the factors that led to it, challenging the conventional wisdom of free market economic theory. The book delves into the history of economic thought, the consequences of financial deregulation, and the disastrous innovations in the mortgage industry. Cassidy also scrutinizes the roles of key figures such as Alan Greenspan and the influence of faulty economic beliefs in shaping public policy. By examining the concept of rational irrationality, he argues for a reality-based economics that takes into account the market's inherent imperfections and the need for regulation.
The true causes of the 2008 financial crisis. The 2008 financial crisis took the world by surprise, even the top-level regulators. The collapse of Lehman Brothers caused a panic among banks, which deepened an already existing economic recession by shrinking the willingness of banks to loan money. The crisis was caused by the bursting of a massive bubble of inflated U.S. home prices, which affected consumer faith in the value of residential real estate. The bubble burst because of the purchase of too many securities bundled with subprime mortgages that were in default. This led to a plunge in overnight lending between banks, as financial executives were uncertain about each other's exposure to the mortgage mess. The notion of financial markets as rational and self-correcting mechanisms is an invention of the last 40 years, which is what led to misguided public policies and deregulation that brought about the crisis. The financial sector of the economy defies the theory of market equilibrium, and classic economic theory fails to capture everyday realities of financial markets. Adam Smith's economic ideology. A famous Scottish economist, Adam Smith, was a promoter of the free market whose book, The Wealth of Nations, compares dynamic economic growth to a benevolent, invisible hand. Although he advocated limited government involvement, Smith recognized the dangers and speculative excesses of uncontrolled financial markets. He believed that banning banks from issuing interest-bearing notes to speculative lenders was necessary to prevent recurring gaps in credit availability. Smith's position on government intervention highlights the importance of controlling risk, rather than relying too heavily on statistical models. The dangers of free market deregulation. The U.S. government's deregulation of banks and financial institutions put the banking system at risk. Their attempts at encouraging free market competition in the market for bank deposits pushed banks to put money into high-return assets, leading to high-risk loans. The repeal of regulatory caps on interest rates banks could pay depositors, as well as the lifting of the Glass-Steagall Act, allowed banks to engage in investment activities that resulted in banks like Lehman Brothers and Bear Stearns collapsing. Policymakers requiring banks to adjust their capital based on credit ratings caused credit rating agencies, such as Moody's, Standard & Poor's, and Fitch, to replace government regulators. These agencies become the leading examiners of banks and their balance sheets, although their assessments became unreliable due to the inherent conflict of interest arising from debt issuers paying for credit ratings. Liar loans, and option arms, among other innovations, resulted in the 2008 financial crisis as lenders made new, riskier types of mortgage loans to subprime borrowers. The banks sold these loans to investment firms, which packaged them and resold them to American and global investors. Unfortunately, the upward trend in housing prices blinded some parties to the possibility of a national collapse in residential real estate. Alan Greenspan's economic legacy. As the Federal Reserve Chairman from 1987 to 2006, Alan Greenspan spearheaded policies that led to a borrowing frenzy and a laissez-faire financial environment. He championed low interest rates below 2.5% in the final years of his tenure, encouraging reckless lending. Greenspan also criticized the Glass-Steagall Act, allowing commercial and investment banking to operate freely. By the end of his term, the U.S. had accrued massive debt due to the expansion of credit availability brought about by low interest rates and financial deregulation. Greenspan's economic legacy remains controversial. The rational irrationality. The book challenges the free market doctrine and discusses the limitations of rational behavior in economics. Empirical research suggests that stock prices exhibit momentum and can lead to a rational herd behavior among investors. However, this phenomenon pokes holes in the free market theory that stock prices are always a reflection of all the known information. Additionally, herd behavior among investors can distort price signals. The book also argues that rational irrationality, in which individuals make logical decisions that serve their self-interest but produce disastrous results for the group as a whole, is an element of reality-based economics that conflicts with free market, utopian economics. The prevalence of rational irrationality is illustrated through various economic phenomena, including the collapse of the investment bank, Bear Stearns. The author suggests that a new way of thinking about economics needs to be articulated as a replacement for utopian economics, an economic philosophy that acknowledges the usefulness of markets but also their limitations. The role of regulatory intervention in the financial sector. The financial sector has become a Frankenstein's monster that can cause chaos. Regulatory intervention is necessary to prevent financiers' speculative impulses and maintain stability in the economy. In March 2008, the Fed made a $13 billion loan to Bear Stearns as its collapse could have caused many money market mutual funds to fail. However, Lehman Brothers was allowed to fail 6 months later, causing a global slump in lending. Critics argue that the too big to fail policy is an assault on the free market, but regulatory intervention is still justified. Lawmakers should expand the Fed's mandate to include preservation of financial stability. Without significant regulatory reforms, irrationality will continue to create financial calamities that affect the entire economy.
Cassidy's How Markets Fail dissects the 2008 financial crisis, revealing its roots in the misguided belief in perfect free markets and the consequential deregulation of the financial industry. The book argues for a more grounded, reality-based economic philosophy that acknowledges the limitations of markets and the necessity of regulatory intervention. By asserting that the idealized free market is a fiction, Cassidy proposes an alternative way of thinking about economics and calls for reforms that would prevent future calamities in the financial sector. Ultimately, the book urges readers to confront utopian economics with reality-based economics in order to create a more stable and sustainable financial environment.